Hello, folks. This is David Russell, Global Head of Market Strategy at TradeStation. Great to be with everyone today. And now we are starting this webinar. Great to be with you guys. Let me start off with some disclosures. There is a link on the TradeStation. There's a blog post on the TradeStation website. Those go to some different things, including some of our disclosure pages, and to the TradeStation website where we do a blog post. For each webinar, we do a blog post. So if you go to TradeStation.com, let me just quickly show you where that is. So if you're on TradeStation.com, and then you go to Insights, it'll bring you to this blog post. It'll bring you to this blog, the Market Insights blog, and then you click on this. This is the actual rundown that we're going to be using today. So interesting market. Last week we talked about the development of resistance at the gap following the Fed, the kind of steepening downtrend, and that has kind of played out. We ended up last week with a bearish outside week on the S&P 500, and we're going to be getting to those things. So now, if you guys go to this blog post, if you are new to us here for Market Trends, you can go to the TradeStation website and find this blog post. And in here, we have some workspaces that we can share with you if you're a TradeStation customer, and you can then load them on your TradeStation platform. So some of the big things we were really looking at here, if I look here at the chart of the S&P 500, was the, really this gap. We had talked about after the Fed, it made this bearish gap that became resistance. We have been watching for support around this level, around 42.35. I'm sorry, 43.25. That was the high from last August. We noticed how we slipped back under it, and then the price action turned into a large kind of bearish outside week that really kind of dragged on things and gave us some follow through today. So the S&P has been down for it's only had one green candle in the last several sort of probably the last week and a half. So this has been kind of as the intermediate trend gets more bearish. This is a sort of intensification of the move we're seeing. Counter trend moves, in this case, bounces get smaller, and we get more of a strong, smooth move in the direction of the trend. It was true in the upside here, and now it seems to be playing out the same way at this moment for the S&P 500. So I think right now we take a look at the bigger thing. We talked here last week. We talked about how multiples and earnings valuations are at risk at a time of rising geopolitical risk. Now, we had talked about many different things. If you look at the webinar we actually did last week, and some of these things have kind of played out. We had talked about, if we look at our previous rundown, we had talked about things like, the fact that a combination of higher for longer and geopolitical risk may pressure valuations. Another thing was we talked about Apple coming under some pressure with issues in China, with Huawei taking market share, and then something here about the MacBook losing. But it's interesting also, if we look here, here's an article this is on Seeking Alpha, but it actually started on Reuters. There was an article that basically said Chinese retailers are giving big discounts for the iPhone 15. So we're seeing a continuation of this. And I think this is something right now that really is kind of the narrative of what is happening, is that the people are taking a look at the market and they're saying the valuations right now on some of these tech stocks don't make as much sense. And it's not just because of the Fed. It's because of things like what happens if Apple does start to lose market share in a place like China. When we see things like the Android gaining market share, maybe it's based on politics. Maybe it's just a normal market trend, of market share gains. Maybe the new Huawei phone is better or something. The key thing is that if this becomes a trend, it simply means that people are not going to be willing to pay as much for a stock like Apple. And I think that's the real reason. Now, Apple reports, if you look here on the TradeStation platform, we have, the next earnings date function here tells us earnings are after the bell on the 2nd. A lot of you guys probably know that. But I think the thing here with Apple is, to me, this is, something of a risk of seeing things kind of continuing to weaken in China. What I'm really seeing here when I look at this earnings season, we look at the response to something like Google or Alphabet or Meta. My sense is actually that something kind of insidious and is happening here, which is that people are taking advantage of earnings season to sell. And I think that's actually something that we have to kind of focus on here. And my sense here is that what we're really seeing is people are looking out and they're saying the stocks don't demand the valuations they should have, because if we have Chinese issues dragging on things like the semiconductors, because we have this back and forth with China and the Biden administration, that knocks down some of the valuation of the tech sector. You look at it with Apple as well. So people are looking out and they're actually saying, do we want the valuations to be where they are? Are these businesses as impervious to risk as people kind of thought they were? So I think that's one big issue here. But then the other thing is, with rising interest rates, and then some of that's the other obvious thing that's out there. But something else did come from the Meta results, the Google results, and the Snap results. And what we found was that they say that advertising is going to be hurt by the unrest in the Middle East. And I guess it kind of makes sense when you think about it. When there's all these, people showing pictures of war, or, people want, one side versus another, there's a lot of emotion. There's a lot of, it's a situation where it's easy to offend people on either side. It's easy for people to get upset, and, all these political issues that surround a situation like we have now, unfortunately, in the Middle East. It's not good for online advertising. People are not going to want to advertise, especially on the social media platforms. And that now is another wrinkle, because now suddenly what Meta did was, one of the two, I can't remember which of the two, they widened their guidance on revenue, because they're like, we don't really know what's going to happen. So now there's another fear that's coming into the market. So I think it's important to realize here is that a lot of these people viewed them as kind of impervious, bulletproof businesses. They're not economically cyclical. They're safe growth, all that sort of stuff. And now maybe that belief is not as strong as it was. And as that happens, multiples come down. And I think that's really the main thing we need to focus on here. It's not so much a question of even the quality earnings per se. It's a question of, the long-term valuations that these companies have. We knew interest rates were rising, but now I think we're starting to consider as well the geopolitical questions of what that could mean for global companies like Apple, Meta, Google, all these kind of companies that have a global footprint. This is now something that I think is entering into the equation that was not there before. Okay. I wanted to see if you guys have any questions. Go ahead and tell me. With this new software, I should be able to see. I should be able to see quotes of people that are putting in. Again, I apologize for any technical issues. We're learning this for the first time. It's a new piece of software that allows us to go on Twitter and YouTube and do a webinar all at the same time. We had a little bit of an issue with our webinar on the TradeStation website, but we'll have it up and running soon. So I apologize if anyone had issues with that. Okay, so let's look at some of the other things we wanted to point out here in our rundown. So, like we said, all right, let's look at this one. There was a bearish outside week, and now if we look at the S&P 500, we're under the 200-day moving average for the first time, since March. The 100-day moving average is starting to fall. Now, I've said before, we look at the S&P here, the 100-day moving average. In my opinion, this is actually for direction of the longer-term trend. I don't really think the 200-day is especially useful. We actually one time, I don't have time to get into it now, but we one time actually optimized, and we said, which of the long-term moving averages is most, has the most ability to kind of anticipate the directional turns in the market over the longer term. So we used TradeStation's back testing. I created a custom indicator that basically went long or short, hypothetically, of the S&P 500 based on the change of direction of a single moving average, a long moving average. And I actually found that 111-day moving average was the one that had the most ability to anticipate longer term trends. If you look at the performance 12 months after the turn happened, I can go back and dig those things out. And nothing, this is a recommendation, but if you're new to TradeStation, we have the ability on our platform to do things like that, to test and see which indicator, which setting on an indicator is going to give the most accurate sort of responses or the best reads on the market. And we actually found that with a 111-day moving average, basically when it changes direction, it can actually tell you where the market is going for a period of months and quarters into the future. And so, I had always looked at the 100 myself, not the 200, because often by the time you get to the 200, you're already in a pretty ugly situation. And so what's happening here is the the 100-day started to turn negative right here. So we had done this previous chart, and I'll just bring back this chart. I'm going to make this a bigger. I have it somewhere else. In fact, wait a second. I have it. MT blog. I have so many workspaces, so many charts. I'm like someone who has too many kittens, right? Except I have too many charts. I love them all, and sometimes not sure which one to look at. So this is the 20, the 30, and the 50-day simple moving averages. And I've just noticed, in and of itself, these are not going to give any immediate signals. But when you see them all kind of line up in a certain direction, like they did here, and like they do here, you have a pretty clear establishment of an intermediate term trend. So from my perspective here, this is going to be a real kind of weight on the market, on the S&P 500 for the foreseeable future. We had talked about the sharpening of the downtrend that we saw here. There's a trend line here. If we look at the previous webinar, we had shown here, there's this trend line, and then it got steeper. So the decline steepened. And so I think we're seeing now that acceleration. And at this point in time, in my perspective, there's a few things that can happen. We can kind of stabilize here and chop and sit for a period of time. Or if things continue to worsen, it could just be a continuation and a deeper, push to the downside. I think right now we have to realize that there are a lot of positives in this, in the market right now that I am going to get to. But this geopolitical thing just creates this overhang of uncertainty. And the thing that, like I said, is most concerning to me is it looks like people are using earnings season as an opportunity to sell, because very often we'll see with institutional investors is that something is true. And I think we've probably all had this as retail investors. Something is going to happen, or you have a sense of it. You put the position in, doesn't work, it crashes against you or something. Then earnings come out, and then the stock rallies the way you think it's going to go. And so very often what I've noticed is that earnings reports are simply liquidity events when large money can come into the market or leave the market. When people are looking to do large amounts of stuff, they wait for that sort of volume spike you get around earnings. And what I think we're seeing right here is that that's what we saw with Tesla, Meta, Google, and some of these others. So what's also interesting to me is the violence of the drops. Like if you look at Whirlpool, this was to me a stunning drop, because it kind of shows, I think, people a little more of a hair trigger here to the downside. So from my perspective, this looks like a market where people are, it's more in a kind of distribution bearishness here. And, I think we have to be careful of trusting it too soon, because, at this point in time, the situation in the Middle East, we don't know when it's going to end. We don't know exactly what the end of it even looks like. Then again, if you look here at our rundown, what do we have? We have basically the Fed. We say here the calendar. We always try and look, when we do the market trends, we look at basically the trends in the actual S&P 500, things like higher highs, higher lows. We look at different indicators, overbought, oversold. We look at key levels. We look at things like Fibonacci retracements and stuff like that. We also look at the calendar, and we say, what is that kind of event that is going to suck the market toward it? Very often you get these events, I kind of call them magnetic events, when the market is just going to gravitate toward an event. And if people are saying, I'm going to be a buyer, like I said, with earnings, we also have those in the broader market. Things like the Fed meeting next week. That is a big sort of magnetic event. And then we have payrolls after that. So from my perspective, if we are going to get more of like a relief rally, it might come after the payrolls, after the Fed a week from yesterday, 6 days from now. So, it's important, I think, to bear in mind those sort of events. Another thing that we have on this is the chart I actually use to do the markups on. But we basically looked at the S&P 500, and we did a Fibonacci retracement of the move from the end of last year to the high of this year. And what was interesting was at this level around 42.25 was important for a lot of reasons. First of all, it was pretty close to, February was the high, just under that. And then we had the debt ceiling back here when we had that, and that was good news. And there was like that kind of relief rally coming off of that. So it had that level just based on history, but it was also a 50% retracement of the year's rally. And now it is under that. So it's just one more thing that suggests that this is not actually the trend that exists. And so for me, what's concerning is the lower weekly highs, the lack of a breakout relative to last year. If we just let me just quickly just you can see. I mean, if you look at this, these are lower weekly highs. And so for me, this is a situation now that is a little bit less sort of, it has the longer term, the intermediate term have less bullishness than they did even with this first bounce here. The inability to hold this level from last summer to me was a pretty serious violation. To me, when we went under that after the Fed, it was like a problem when we tried to reclaim it and then we couldn't keep it. To me, that was really when things were much more sort of damaged from a technical perspective. All right. Do you have any questions? Looks like I am seeing people's comments. If you have any questions, please put them in if you're seeing them on YouTube or wherever else you might see them. So what I actually did is I looked at these numbers from Refinitiv, and it looks like the S&P earnings are going to be 219.74. That was the most recent number they came out with. What's interesting is it's actually been inching down. It fell by an entire $1 since the beginning. This is for the overall index. It fell by $1 since the beginning of the month. So the thing, though, is if you start to kind of put different earnings multiples on it, that's kind of what we do in this rundown. A multiple of 18 times would take us under 4,000. Now, this is this year's earnings. But anyway, I wanted to share that, if we go to 16 times, you'd be at 35.15. Now, of course, these are just, simple math I was doing. I want to just kind of say that if we look at, multiples, if we believe multiples are too high, if that is something the market wants to obsess over and worry about, then this sort of conversation will become more commonplace. All right, so let me see some of the other things I want to mention very quickly. I mentioned about Meta and Google and the advertising, which to me was an issue. Also, if we take a look here at UPS, a bad outlook today, getting really hammered. So, UPS is one of the biggest transportation stocks. What is interesting is, transportation stocks have been doing very poorly recently. We have a DJT here, DJT, the transportation index, Dow theory. It has been, very much showing signs of stress. I think actually, me personally, I believe that the transports have lost relevance for a few reasons, including the fact that airlines are such an important part of them, and airlines are heavily debted companies. And, with interest rates going up, they are more vulnerable to higher interest rates. And I don't believe that the transports here are giving the signal on the overall market and the economy the way that, historically or traditionally they're supposed to. The idea of Dow theory is that weakness in transportation means the economy is going to do badly and there's going to be a recession. Today's GDP number was higher than expected. And a lot of other numbers here, there's no real economic weakness. So from my perspective, the transports here have lost their relevance as an indicator. But it is interesting to see something like a name like UPS. Because what is interesting, if you dig into some of the data, and I'm going to get to this, but we have a situation now where the inflation situation is getting a lot better. And the weakness in UPS actually, I think, is overall bullish because, things like transportation services, a lot of these things, these are the services, the core services that the Fed worries about. Well, if transportation costs and UPS shipping costs are going down, that actually is a good thing for inflation. And I think we're seeing that, and we're seeing it in multiple places, including this report I was going to turn to from S&P Global. This is their flash composite index. And the guy in here basically said, this is his comment. He said, hopes of a soft landing for the U.S. economy will be encouraged by the situation in October. He said that it was very downbeat, but now we're seeing a turn in output. Prices are low. Companies are actually passing on cost savings. So a lot of the numbers here, this whole idea of this inflation, we continue to see improvement in the inflation situation. Today we had GDP better than expected, but core PCE inflation was 2.4 versus a 2.5 estimate. We continue to see the inflationary situation improve. And I think, this is what I mean when you look deeper under the surface. The economic situation is very good with GDP beating estimates and the inflation situation getting better. The thing that's really happening now, I think, is a debate over multiples because of high interest rates and geopolitics. And I do think that this geopolitical thing is going to become more of an issue. China did something just today. Here it is. All right, there's an interesting article here. If you maybe look at on Reuters, China rushes to swap Western tech with domestic options. So, I mean, if we are in a stage of more kind of tit for tat between Washington and Beijing, that has a lot of risk for the tech sector, for semiconductors, for Apple. And I don't know them case by case, but there are companies out there, you have your companies like your Cisco, your Applied Materials, and these are the companies that make up the kind of, the bread and butter of the NASDAQ 100. A lot of these, like, you go down the tier a little bit. And, you go down a little bit in size and you find there's a lot of these kind of companies that have, especially the semiconductor side, the device side. These guys, if China starts cracking down and doing stuff, it creates all kinds of uncertainty in the technology space. Tesla is obviously a name that could be at risk. So I think right now, this is not a question of the economy. It's not even a question of interest rates as much as it was. This is going to become more of a question of geopolitics. And then, the question of everything happening in the Middle East, does that have some kind of trickle down effect? If we actually start to see more kind of, tensions between, Russia and China. If you look, and there's been stuff in the UN with, resolutions, Russia and China on one side, the US on the other. Well, as these things start to happen, this is how, divisions can start to happen. And I just think it's important that I have seen more and more stories like this in the last 3 weeks. And we talked about it last week, and now we see more today, like this thing here, Chinese retailers seeing the iPhone discounts. Then last week, we saw this thing coming out from Jeffries. Jeffries basically saying right here, iPhone loses leadership in China. So here we go. Jeffries says it one week. Reuters reports it the next. Where there's smoke, maybe there's fire. So, this is, I think, what's happening. And I think we have to realize that this is a story of multiple compression. All right. That was last week. Let's get back to this week. So I do mention this thing with this guy from S&P Global. The macro environment, like I said, is getting potentially very positive here. We continue to see incredible strength in housing. Well, I don't want to say incredible strength in housing, but we're seeing housing is just like fighting against this tide of high interest rates. New home sales beat. Today, pending home sales beat. Both of these are for September. In my view here, if we start to see just the glimmers of interest rates coming down, the home builders have, potentially a lot of support under them, a lot of demand that is going to, perk up. And I think this might be an area, the ITB, names like Lennar, DR Horton. These are the kind of stocks right now that I think, with if interest rates do peak, maybe these are the post-Fed, relief rally names. But I wanted to just kind of point that out because I think right here, we just have such a structural shortage of housing and, not just a shortage of housing, but a shortage of people moving. There's people for the last 18, 20, probably the last 12 to 18 months who haven't been able to move. So you have a normal friction always in the United States of just people moving. And as that sort of, glacier, thaws, as that freeze goes away, it's going to trigger activity in the housing market. And so I think the home builders here are a name that have been just kind of languishing and sitting. Let's just take a quick thing. Look at DR Horton. Now, do a little trend lines on this one. Because if we look at DR Horton coming down here, what do we see? We see a falling wedge. This is a bullish reversal pattern. It's squeezing down. It's making lower highs, but we're not getting the follow through to the downside. And I'll be honest, I'm seeing this pattern in a lot of things in the overall market. The problem with a falling wedge, though, is that, you have to wait for the breakout, and it doesn't always work. Nonetheless, this is something that some people might be noticing. It works a lot better for a bearish reversal when something has this to the upside, when it's a rising wedge. But this is nonetheless, we're seeing this pattern. If you look at most home builders, they're doing something like this. So I think it's interesting just to kind of bear this in mind, and to keep an eye on the home builders, because with interest rates and the demand where they are, this could be one of the first areas to benefit. Yeah, home builders were at one point the best performing industry on a year-to-date basis. That kind of ended back here when rates started rising, in late June, early July. However, they still are. Let's take a look over here on our workspace. This is a workspace on the TradeStation platform. If you guys don't know about it, radar screen. And what I do here is I have a series of ETFs that I use to judge relative strength over different time frames. If we look on a year-to-date basis, we can see that home builders are up 19% versus an 8% gain for the S&P. So the semiconductors are up more. At one point, home builders and semiconductors were tied, but these guys have pulled back much more than the semiconductors. But I wanted to just kind of point this out because these guys are still outperforming on a year-to-date basis. If you look in the last 3 months, they're absolutely not outperforming. They have been. Let's go back to where we were. They're down 19% in the last 3 months, but they are still up on a year to, the S&P is down 9%, and these guys are down 18% in the last 3 months. But on a year to date, they're still more than double the overall index. So home builders, I think, remain a sort of an area that where the underlying fundamentals are pretty interesting. All right. We can also see, I was noticing this earlier. Let me take a look here at growth versus value. IWF is the growth index and IWD is the value. And so, the last few days, we've seen value sort of doing better. The value related parts of the market. If we look here in the last week, let's actually take a look and see who's doing best in the last week. Utilities, Chinese tech stocks, which have, they've been chopping all over the place. I think they had a lot of negativity in them, but utilities, consumer staples, real estate, those are the best performers in the last week. These are all kind of non-cyclical safe havens. And, in some ways, I think that their strength is actually kind of meaningless because the thing is that they got hit. So it's like utility ETF here. These guys got hit so hard based on interest rates that they have a little bit of a snapback. But I think you also have to just realize that this is not giving you any clear signal. The main signal it's giving me is that safe havens are outperforming, and that is a bearish signal. So when you look at the market overall, what's interesting, when the market was outperforming earlier, when the market was doing well earlier in the year, the outperformance came from technology, industrials, consumer discretionaries, risk-on sectors. Now, as the market struggles, we're seeing outperformance from the safe havens. That is a bearish internal of the market. Well, it often is. And I've noticed that consumer staples often outperform before the market crashes. And in this case, they didn't for various reasons. And we were on this webinar, very bearish on some of these consumer staples and stuff, in the, August, September period. Now that's kind of run its course. But I did want to, just mention that the relative strength now is showing more of a conservative risk off sort of tone. All right, let me know if you guys have any questions. I'm not seeing any more comments come in, but hopefully everything's coming through clearly. Again, I want to thank everyone for bearing with the different technical issues and stuff. Now, remember, we have been watching for 5.25 on the 10-year TNX.X. 5.25 was a long-term sort of high going back to 2006 or something. We got to 5%, and we're just kind of chopping there. And, I think when you look at this as well, though, still have higher lows in place. There's nothing here that really seems to suggest a clear sort of, top. This is something just to kind of watch. But again, I think with the Fed meeting coming up, that could be the actual thing where anyone who wants to be a buyer and look for this to peak, because these are yields, anyone, there's a good chance they're going to wait until the Fed meeting. Now, it is interesting. We noticed that Bill Ackman covered a short position against treasuries. That was kind of interesting. But, the thing that's still driving treasuries here is the Fed. It's not even geopolitics. It's not Bill Ackman. It's that expectation of the Fed. So last week we talked about the negatives in energy. And I'll be honest, like, I'm baffled with the think of the situation right now in the Middle East. Typically in the world of investing, you want to ignore geopolitics, ignore the scary things out there. But at this point, I think it's just there's too much potential of something getting worse. There was articles today saying that Israel is going to start incursions and stuff like that into Gaza. So when all those things happen, from what I have no prediction of what's going to happen or what the Saudis are going to do, but the market is going to say, wow, the Saudis might do this or that, or it escalates with Iran, and now we're talking about the Straits of Hormuz and these things, and then suddenly questions of risk of oil squeezing and stuff get a lot more intense. And I think that people know that now. So energy had a really strong pullback. We did notice in XLE. We had talked about XLE. The last time we did this webinar, we pointed out that bearish outside candle right there, and we got the follow through. But at this point in time, it is interesting to see that. I'm looking at oil again today. I was looking at the USO, for example, or look at crude oil. Let's look at crude oil futures. They had this kind of big candle, kind of, a big gush off the lows yesterday. And, this kind of hammer of just trying to be defended here. So I'm not really sure about this. I want to just point out that the negative things I said about energy have played out. But, I think that we are going to see more supply. I think when you look at history, we're probably going to see a flood of oil in the next 3 to 6 months. And my view is that, as long as nothing really terrible happens, we all pray that things, end soon. But, from my perspective, there is the fundamentals are not good for energy. We are seeing more supply come online. And in my view, it's only going to increase. I think when you look at the purchase of Chevron, buying Chevron and Exxon, both did big deals. They bought PXD and Hess. These are the smaller producer stocks. So, these guys previously were using their cash to pay dividends and buy back stock. Now what are they doing? Now they're issuing stock to buy production. So they've actually done a 180 in the last 12, 18 months. Remember when Occidental, everyone was talking about Occidental Petroleum, they're paying out all this money. This was a year and a half ago when the government was saying, hey, let's shut down the oil and gas industry. Let's have them pay out. The theory was let's induce the oil and gas companies to do stock buybacks and pay dividends and not invest in oil and gas wells, not invest in production, and then we'll have green energy take over. Well, the thing is that when you see the deals like Hess and Pioneer coming into play, and then you see headlines like this from CNN, ESG investing is dying. And we've been talking about this on Market Trends for multiple weeks now about the kind of crumbling of Larry Fink, even Larry Fink saying this thing is fading. We've been talking about this for weeks now. You look in the last few weeks, what is the worst performing, like in the last month in the market? Solar energy. The last 2 weeks, solar energy is the leader to the downside. So in my perspective here, we're more likely to see the shift go away from green energy and back toward tolerating, embracing, accepting, fossil fuels, at least for a while, especially the election year next year. I think that Biden is more likely to push in the direction of getting prices down, refilling the SPR. And so from my perspective, it's more of, that's more likely where we're going to go. And so my view is that when we start to get away from this tension in the Middle East, I think we're seeing already. There was an article about at the beginning of the month in the Energy Department basically saying that oil companies are now ramping up investment in oil and gas fields, and they are. It was an interesting article. It basically said they're now borrowing to finance future production, and they hadn't done that for apparently years. They were financing future production from cash flow. Now they're actually borrowing. It was, I think, on October 4th. If you dig around in the Energy Department website, they said this. So anyway, all these things, in my view, kind of suggests, and we've seen this countless times with the energy industry, when the cure to high prices is high prices. The supply comes, and then what happens is oil just nosedives. And if you look at the history of oil, for especially the last 15 years, let's look here on a monthly chart, crude oil futures on the TradeStation platform, looking on like a monthly here. I mean, this is kind of, if you look back here in 15, look at, we saw this when the production took off, and then basically going into COVID, there was a flood of oil. So I wanted to just point that out. In my view, this sell-off in oil, a collapse of oil is coming, but for right now, the tensions are holding it up. But let's just kind of keep that in mind. I think it'll be interesting to kind of watch what happens. I think if we really start to see a breakdown in oil, it could also tell us that the situation in the Middle East is improving, because those guys, the oil traders, a lot of them are not American, first of all. So they know what's happening in places over there. They're trading overnight, in London and stuff. So oil, I think, will be a really important thing to watch. All right. Now, I'm just looking at the different points I wanted to make. We're talking about just kind of the safe haven demand. Let me look at some of the things where we actually dig into some of the signals that had kind of popped up. One thing for me was Roblox. I mean, this is one that could be setting up for some more downside. This was a company that basically, has never really achieved what people hoped it was going to achieve. I don't know how else to put it. I mean, they've just disappointed almost every quarter, from what I can tell. Really, really, if you're a bear, I mean, this is just a perfect gap to see as a signal to the downside. It goes up, toys with it, comes down. This is one I think is pretty interesting to see that, into year end, how does a name like this perform? I think this is one that could have some downside continuation to year end. We did a trading view idea on Snowflake. Was interesting here. If we look in the actual webinar, we in the rundown here, we go to our trading view ideas, and we kind of showed some of the ideas, but we looked in particular at Snowflake, which tried to get above its 200-day moving average, failed, had the death cross. This company is incredibly high multiple stock. Another name, it doesn't look that different than Roblox. And so again, for people worried about valuations, some of these super high valuations sort of tech stocks, could be kind of in play. Now, another name, talking about China, that looks, to me, this kind of is Starbucks. Starbucks has been trying to grow in China, struggling. It's an iconic American brand. And, again, it's not that different than Apple if you're a Chinese sort of, if you're the Chinese public. And, the earnings on this one are actually the morning of Apple on the 2nd of November. But this name is actually kind of interesting to me, I think. Everything about this kind of gives an indication, maybe not everything, but I see a lot of indications here of a downtrend, the 50-day moving average coming down and kind of just coming off of that moving average. We have our Keltner channels here that it's coming off the top of the Keltner channel. If you look here, this level around 96 was kind of a resistance level. 95 was a support. I'm sorry, it was a support level back in early July, and now we're basically stalling at it. So to me, for momentum, Starbucks could have some downside. It was interesting to me to look at JP Morgan, which is more in the opposite direction here. JP Morgan is trying to hold some levels here from the first half of the year. There's a lot of negativity here, obviously, with the this intermediate term sort of downtrend that we've seen at JP Morgan. But trying to hold kind of 140 here, I think this is one that people might want to be kind of watching. This is kind of a higher quality name, and a member of the Dow, not a tech stock. This could be one that people kind of target, of looking if there is something of a look toward kind of value and that sort of theme. Disney, however, has just a pretty steady, kind of downtrend here. It was coming off the 50-day moving average. Micron was the one that I did a trading view idea today, and to me, it looks especially kind of like an opportunity for the bears. Let's actually look at the trading view idea that we actually did here, because what was interesting to me was this stock had a bearish outside day yesterday, And we did this, and the stock kind of did break lower after we did the article. I think there was something negative that came out on Seagate. What was interesting is this stock kind of remained it never really reclaimed a whole lot versus last year. If you look at it, like Apple went to a new high, Microsoft went to highs, and this thing didn't get anywhere near, Nvidia went to new high this year. Micron didn't do anything like that, not even close. And now you have this kind of convergent triangle. But what's really interesting is you see that the 100-day, the 200, the 100-day moving average, a 50-day moving average, they're right there. It's just straddling all of those. And that in many ways tells you that it's kind of losing its uptrend. You want to, people looking for a bullish trend, you want to see the stock remaining above the moving averages, not kind of just sitting on top of them. So to me, this is one now that has this potential of, potentially a pretty, maybe odds of a breakdown here kind of coming along. So I did want to mention this one. We had done an idea on Procter & Gamble based on a similar chart pattern right back here when it was basically just sitting on its 50-day moving average, not doing anything. It also had kind of a trend line along here somewhere. And we did this idea, and then it just kind of broke lower. So to me, there are some similarities here. What's also interesting is it made a lower high versus previously. Now, if you look at Micron, it does the same thing. This is a lower high, right? So you have this high and then a lower high, and then it sits at the 50-day, and you have the rising trend line that it breaks through, and then you just get the whoosh to the downside. So to me, Micron here has that sort of downside potential. Dollar General, these stocks have gone from darlings to just dogs, I guess you could say. Dollar Tree, Dollar General, the discount retailers really gotten beat up. And this one gap lower, it's clawing back up. This is one that, I think we look at this, it might take about 4 to 5 days to really kind of stall. It has the 8-day exponential coming up from below. The short-term momentum is very bullish. But, when it fades, this is one that people could say, especially in the year end, we could see, some momentum to the downside. Square or Block, same sort of patterns. Just continuation here. High multiple stock that is honestly in a very crowded space. I mean, a lot of these, look at PayPal this year. I mean, these fintechs have been under massive pressure. Square here. What's interesting though is it hasn't made a new low for a month. And when something is trending lower like this kind of consolidation, if you look consolidation, move, consolidation, does it get an extension to the downside? Dexcom. Now, these diabetes stocks, DXCM, their business has really unraveled because of this idea of weight loss drugs replacing diabetes treatment. And, they went from being, in many ways, safe, steady businesses. I guess I don't know much about diabetes, but I'm thinking people who get, you get your dialysis or whatever on a regular basis, or I'm not even sure exactly what it is, but, this was something that was viewed as a steady business that you could count on over time. People paid a premium for a stock like this. And now suddenly weight loss drugs come along and just kind of jeopardize the entire project or the entire business model. So these guys have really taken a beating. There's several others, but Dexcom was the one. I did a scan for stocks that had rallied off lows, that had been trending lower. I was looking for stocks I don't know exactly what the scan was, but I did something like, the 50-day below the 100-day or below the 200-day, but had rallied in the previous week. It's a real simple scan. And we'll show you how to do it in a future webinar. But with TradeStation, you can create scans like that. I have other scans. Let's actually look, if you guys haven't seen this yet, if you're maybe joining us on YouTube or something for the first time. If you look here, we have a thing called MA Tools on my radar screen here in the Market Trends workspace. Now, remember, this is something that we provide to you guys. If you have a TradeStation platform, you can basically download a zip file and put this into your platform, and it'll work for you. It has some custom indicators I created. I'm actually going to repopulate the S&P because since I originally did it, the S&P has changed its members. So I'm going to re-add this. But what's interesting here is you can just see, this is called MA Tools, and you can just see stocks that are trending lower that, it's loading the data now. But, I look at stocks here that we're testing the falling 21-day moving average. And you can just see right here, for example, I haven't even seen these yet. I'm just looking today. AMP. I think that's a mutual fund company, Ameriprise. See, the 21 day is the gold moving average. So what this does, this tells us two things. It tells us, first of all, that the price today is touching the 21 day. And because it's red with the minus sign, it tells us that the moving average is falling. So this can give us signals. If it's green, it can be a potentially bullish signal. Like, for example, McKesson. Today, McKesson is holding the rising 21 day exponential. That's a potentially bullish signal. They report earnings next week. You can see. So you're getting a lot of information right off the bat with this. I'm using the S&P 500. You can put in your own list of stocks or whatever. But these are some of the tools I use to kind of come up with some of these signals. I did want to mention here, my mover of the week was Verizon. And, you know, this is the kind of stock that perform well in an environment like this. What's interesting about it is it's completely on its own program. I mean, you could have, who knows, recession, whatever, war. I'm just, not trying to say that with glee. I'm just saying, like, you could have all kinds of things happen in the world that are bad for the market. And a company like Verizon, it's domestic, it's not especially cyclical. It's the kind of stock that can do well in a bear market. And that seems to be what happened. Their earnings report was kind of good. And they basically said that they are gaining market share. And where is it? They basically have strong subscriber growth. They're regaining market share. Cash flow is doing well. And the CEO says momentum will continue. So it is kind of interesting to see this. This is a safety kind of stock, but I want to point this one out. We try and identify a stock that is moving on some kind of news that kind of stands out. And this was what I thought was pretty interesting that I wanted to highlight to you guys. Now, tomorrow morning, we are going to have PCE inflation, but the big kahuna is the Fed on next week. Some other earnings mixed in. And then we have, I did not put Apple on this because we're going to have, it's on Thursday afternoon of next week, and I only put in the pre-market ones. But here's a list of some of the major names. Now, you can build a real nice earnings calendar using the TradeStation platform. I'm not going to get into that right now. I'm not sure. I mean, I've shown it to people different times. So I want to kind of get into one or two other things to show some of the stuff I was kind of doing today and what I've been doing in this more bearish market. I don't have a position on right now, but last week I kind of showed the use here of using a chart like this. What I basically did was, this is SPY. And I changed the grid to more easily see the session breaks. And then I put in a paint bar to show the beginning of each session. And I put in a show me to show me when the index makes lows, this big sort of, yellow thing will show me when it makes a low for the day. And then the white cross will show me when it makes a high for the day. So I can see this been going down, making lows and things like that. And so basically this morning, I basically bought SPY puts right there, and I got a good move down today, and it was nice. I closed my position before the webinar, but for me, what I like about a view like this is, you can you let it come down, and then you can kind of see all these levels. And I also have line at bid and line at ask, and you can see how price is coming up and playing with these different levels and stuff. And at this moment, I don't see much of anything. I think we're setting up for a hammer here on the daily chart. I'm not sure that we have a whole lot of clear signals at this point. The market, if you look at it, is pretty decently oversold. So there's two more indicators that I put on here, and then I'm going to show you the way I do it with puts. First, let me load up my Option Station Pro. Hopefully you guys can see this well. I'm not sure. Let me make sure I adjusted the actual font size so you can see it. The approach that I use is gamma. The idea is to look for puts. Now this is short-term sort of use of puts that I do. And it is based on, now none of these are specific recommendations, but it's a way to be thinking about using options when you are in a sort of a fast moving sort of market. And it's something I've noticed. These are short-term sort of things when people are looking to capture the market when it's in a really kind of bared up mode. What you'll often find is you'll get these moves, and these are gifts when you get a move like this. You'll also notice, look, yesterday, same sort of thing, a gap down, then you basically get that rally up, and you don't make a high. See, there's no white cross. It never made a high today. All it did was make lows. So it goes up and then it starts petering out, and then you get price discovery to the downside. And that's kind of what we saw right here. And so these can be gifts if you're ready for them. What I thought was interesting about the price action today was you can see that where it peaked was below that low from yesterday. So this little like line that's dancing up and down here, my bid and my ask, it was under there when it started rolling over. So when people are looking for, options trades, one thing to consider is if you're looking at something like SPY here, is to look for delta and gamma. And what I've noticed, and at this point, I mean, I'm trying to relook at the strikes because we kind of rallied about 2 to 3 handles since I started the webinar. But if a person looks for a delta around 30, what will happen is, say, in this case, it'd be around 412. If the market pushes lower, what will happen is the in the money position will move down. And what will then happen is that delta will increase. So say, for example, you buy 10 contracts with a delta of 30. You will have the equivalent of being short 300 shares of SPY. But you have 10 contracts, which means that if it really knifes lower, you're now short 10 shares. Or 10, you're short 1,000, right? Because it's, every contract is 100 shares. So the thing is that as it moves, if it does, but if it moves in your favor, you get the leverage will increase because these have gamma. So every dollar it moves, it's going to gain 6 or 7 deltas. So if it drops 5 points, which is 50 points on the S&P 500, if it drops $5, then suddenly this is going to gain, 30 to 40, maybe 40 delta. So now you're going to have something like a 70 delta. And that means that as it moves lower, if the bottom falls out of the market, which is, if you're bearish, that's what you're hoping for. You're saying, man, this is just like death and despair, and the market's going to we're going to get the bottom fall out. Focusing on those puts that have the gamma up front, you don't have as much leverage. But if you're right, then it just can move in your advantage. And so that's what I was doing. I was buying basically 30 to 35 delta, and I wrote it down to an 80 delta, and it was nice. And now I don't know exactly what to do next. Again, at this point, I don't have any clear, I'm not trying to make any kind of predictions, no recommendations here, but I am saying this is an approach that if you're in that environment when you feel like the bottom can fall out of the market, you could get a real acceleration to the downside. After all, the S&P cash is under 4,200. At this point in time, that was a level a lot of people were looking at. We're under the 50-day moving average. It's interesting here to see that this level, which was a high for, these are 5-minute candles. So this was a high for a period of maybe, 45 minutes, is trying to give resistance. But in my perspective here, we got to be careful, because if we now go to a daily chart, we have which is going to be a hammer. We're going to see a hammer on the daily. And this is, reversal. So from my perspective here, there's a lot of conditions here that are kind of oversold. And I think we don't want to be, overly expecting too much of anything. It was just that from my perspective, I've noticed you kind of get sometimes, if you're positioned for it, and I just keep as my own workspace. I have this thing set up. And when I see the market in a spot, when I want to be beared up, and I see these moves, they don't happen all the time. But when they do, this use of something with this, with something like the, the way I have it set up, when you have your highs for the day, your lows for the day, you have your, your lines here, when it automatically draws the lines, all those things together can give you a kind of good view of the market. And very often you get these early gifts, a little present, a little manna from heaven that comes along, and you get it early. And, if you're ready for them, you can see it using a chart like this. Like I said, we had that yesterday and we had it again today. So there's 2 other things I want to add. I'm going to add very quickly. There's 2 other little things I've noticed. I'm going to add moving average, a 50-period moving average. Now, this is very short-term stuff. So let's not, let's just be focused on what this is. This is for people who are very active and are sitting in the market all day and, want to be trying to do something like this. So I'm going to be basically putting here a 50 period. And then I'm also going to add RSI. I'm going to actually make it a little bit thicker so I can see it better. And let's add RSI. So there's a few things we see here. First of all, when you have these kind of, oversold conditions, I've just noticed that, things hit oversold. And, that also tells you, walk away. You can see here on these things where you had oversold, but if you're bearish and you're oversold on RSI, it can make sense to kind of wait and, say, hey, I'm still bearish. I'm just not going to jump the gun. And then you kind of get this move, that then gives you more comfort. Now, I can now change this to a 1 minute. And no, this is very kind of short-term stuff. And this is just to kind of, in my opinion, keep you out of trouble. And this works in a bearish market much more than a bullish market. Is that when the 50-minute moving average changes direction, it can tell you it's time to abandon the short side. And in this case, you can see the 50-minute turned higher. So I want to just kind of point those things out. Our webinar started right here at this moment in time, and I exited my position right around here because the 50-minute turned higher. So, I entered right here as it died, and then because at that point it had gone from oversold up to a period where it wasn't overbought, although on the 1 minute chart it was overbought, which is interesting. But then we get down here, it hit oversold, and then the 50-minute turned, and it told me, you know what, you've had a good day, ring the register, move on. So I want to just kind of show that because in my view, sometimes you can see some really good patterns on the SPY with this kind of 1 minute and 5 minute approach. Again, this is not something that should be, something we use often, but when we're in a market, when things really just feel, crushing and bearish, we get those opportunities when we get those oversold bounces in that bearish market. And if we're ready and we have something to set up, we can step in, and we have our strategy of focusing on the high gamma puts and being ready, and also being focused and very disciplined, that when you get that point and you make your money, to walk away and do it quickly. These are kind of short-term things. People can do it with futures. You can do it with SPY puts as well. And like I said, the key thing about the SPY puts is the gamma will increase your leverage as it moves in your direction. And say, for example, like, who knows, say something terrible happened and, something bad happened in the Middle East or something. Iran does something, an oil tanker blows up, and the market drops 100 points. You're going now from being 30 deltas, negative 30 deltas, to now being negative 100 deltas, which means now your leverage tripled as the market drops. So that is the kind of way to think about using the bear side. So it's great to talk to people. I got to jump. Remember, we will be back on next week. I'm not sure if we're going to do it on YouTube or the TradeStation website, but go to TradeStation.com. Check out some of the stuff we do. I look forward to seeing you guys in the future. We will be doing these more on YouTube in the future, but they'll also be in the TradeStation website. Thank you very much, guys. Hope everyone has a great day.